Your phone buzzes. Bitcoin down 6% in 10 minutes. The market drops. Headlines explode. In the group chat, everyone says, "Get out now." Your finger goes to the sell button, and at that same moment, someone steps in. While retail runs, large wallets start buying in silence. It's not luck, it's procedure. How do you notice that without guessing? The drop slows down. Sell orders keep hitting, but price stops sinking and starts moving sideways in a tight band, like someone rolled out a buy mat at the bottom. The flow turns rhythmic. Identical lots show up, spaced by seconds, always in the same zone, steady buy pulses, building a position without drawing attention. The candle leaves a trail. Sharp dump and a long lower wick on the intraday. It went down, someone absorbed, and pulled it back. Who does this has three things: cash, calm, and a map. Wait where most people give up, act when liquidity appears. If they buy when you sell, what are they seeing that most people ignore? Today, I'll show you the whale map, a direct way to read a red day and turn fear into Bitcoin. No myth, no shortcut, clear rules at the right time. Whale isn't a movie villain. It's patient capital with a simple goal: pay less when there's liquidity. In practice, you'll see three profiles. 1. Long-term accumulators. People who want more Bitcoin over years. They prefer discount days because they can buy a lot without moving the price. 2. Treasuries and funds. They have mandates, process, and accountability. They don't feel the market. They execute plans. When a drop creates liquidity, they fill predefined price bands and log everything. 3. Liquidity hunters. Professionals who live off panic. They enter where selling pressure is highest, because that's where there's enough volume to build size with controlled cost. Why do they look like they go against the crowd? Because retail panic sells and opens the order book. That window is exactly when there are enough resting orders to take large entries without slipping the price. That's why you see similar lots appearing in sequence, always in the same zone. Disciplined execution, not impulse. Honest summary: whales don't trade by feeling. They trade by rules and incentives. If the market delivers fear plus liquidity, they follow the plan. And here the map gets clear. Understanding the incentive explains why an ugly drop can be a clean opportunity for those who are prepared. Think of the market like a crowded store. When panic hits, everyone runs to the door at once, and suddenly empty aisles appear where you can push a big cart through. That's what a whale waits for: space. On your screen, that window usually shows three simple layers. Pressure fades, price holds. Selling continues, but the pace slows and price goes sideways in a narrow band. It's not magic. A big order is absorbing what comes out, without letting a new low open. Clusters in the same zone. You see similar lots hitting repeatedly at the same level. It feels like an echo, but it's staggered execution. They enter in parts so that they don't push the price against themselves. Dump with a breath. There's a strong drop. It leaves a long lower wick, and from there the market breathes above that floor. When the low stops stretching, someone is backing the floor. Why doesn't this happen on a calm day? Because size needs liquidity. If a whale buys on a slow day, they lift the price and worsen their own cost. In panic, there's enough volume to build a position without slipping. Read it like this: fear creates discount plus passage. Whoever is prepared turns disorder into an entry point, not in the shouting, but in the pattern. That's where many people stumble. They confuse noise with signal and give up the position right when the floor appears. The scene is almost always the same. Big drop, you feel you must do something, you panic sell, and buy back higher when it calms down. It's tiring and expensive. Trade it for a basic kit, straight to the point. Position size that lets you sleep. Fixed % of bankroll per entry. If it cost you sleep, it was too big. Weekly DCA in Satoshis. Same day, same time, amount that doesn't hurt. No chasing candles, you stack units. Opportunity cash. A slice set aside only for ugly drops. When fear plus liquidity shows up, you use a portion of that cash. No doubling down, no hero mode. Minimum horizon. Decide in advance how long you hold, weeks or months. Write it today, respect it later. 2-minute note. Date, decision, reason, which rule fired. It kills the soap opera in your head and leaves a trail for your process. This doesn't erase emotion. It puts emotion in its place. With simple rules on the table, price becomes background, not a trigger. Want to see it run in the real world? In 2 minutes, we'll simulate a red day from start to finish. Phone alert. Bitcoin down 6% in 10 minutes. 0 to 2 minutes. Watch, don't act. No hero moves. You breathe and check 3 things. 1. The drop slows down. 2. Price ranges sideways in a tight band. 3. A long lower wick prints, absorption at the low. If all 3 show up together, there's a chance of an entry window. If not, don't force it. 2 to 4 minutes. Mark the zone. Mark the floor band where price moved sideways after the dump. Wick region plus the sideways band. It's not a magic point. It's a region. 4 to 6 minutes. Entry in parts, no rush. Deploy a portion of your opportunity cash. For example, 20 to 30% of what you set aside for drops, with equal orders, spaced by seconds, inside the marked band. No all-in. Split entries reduce timing error and cost. Simple mental stop. If price loses the band and starts opening a new low, you stop executing. Window closed. No stubbornness. 6 to 10 minutes. Manage. If price breathes above the floor, you set a short target to take a partial, lower risk and regain control. Keep the rest with a minimum horizon, days or weeks, as per your plan. No making up for a missed week later. Process beats anxiety. Record 2 minutes. Write down the date, reason, drop plus absorption plus sideways, how much you entered, and which rule fired. That trail protects you from improvising next time. What really happened here? You didn't guess the bottom. You read liquidity. When panic opens space, those with a plan enter where most people give up. That's the spirit of the whale map. Use the passage, don't fight the market. With this sketch in hand, lock 2 decisions that prevent 90% of errors when fear squeezes and keep you in charge of your money. Kill the noise for a second. Picture the market as deep water. Whales don't make waves. They move when the bottom appears. Red days are moonless nights. The feed screams, but the order book whispers. There is liquidity here. It's in that shadow that patient money advances. You choose who you are, the foam that disappears in the break, or the diver with measured oxygen and a map in the pocket. The map has 4 lines, simple and lethal. Position size that lets you sleep. Weekly Satoshi routine, opportunity cash, clear horizon. With that locked in, fear becomes raw material. Panic becomes price, and a drop becomes a passage. At the next hit, when the app says down 6% in 10 minutes, will you sell your calm or turn the silence into Bitcoin? If this video brought clarity, prove it to yourself now. Like and subscribe. Here it's less noise, more process, every week. And tell me in the comments, straight and simple, when the screen goes dark, which rule of your map speaks louder, panic or your plan?